How's it going today, guys? I hope you're having a fantastic day. I have a couple of quick updates to share with you guys, but for those of you that are not interested and you just want to get straight to the video, I'm going to include a timestamp in the comment section below so you can click on that. If you just want to skip the intro and get right to the video, that's going to be a pinned comment down below. But anyways, first of all, this video here is actually a collaboration with a friend of mine, Ryan, the independent investor on YouTube. He lives in New York City, but he's actually moving now for his work. And he drove up 4 hours here and 4 hours back. It was an 8-hour round trip just to say goodbye and record a video. So it was really awesome of him to stop by. He has a great channel called The Independent Investor, and this is one of the videos he just did recently. It's going to be part of a 5-part series on investing later in life, portfolio strategies for your 50s, 60s, and 70s. So I know a lot of older people are often commenting on my videos and saying, what can I do to get started with investing? And this would be a great video series for you. So I'm going to link up his video and his channel down below. And make sure you guys jump over and give him some appreciation and some love for taking the trip he did and stopping by here. Second of all, the other piece of information that I have is I have a new course available. It's completely free. It's called Course Creation Companion. It's all about starting and launching an online course or membership site. And I spent about a month and a half putting this all together here. I think I have just under 50 lectures. It's broken up into 5 sections: the introduction, phase 1, the idea, phase 2, creating your course, phase 3, hosting it, phase 4, launching, and phase 5, maintaining. So this is a completely free course I put together just because I have a lot of people that are looking to start an online course that are asking me questions. So I kind of felt obligated to put this together. And that again is down in the description below if you guys are interested in enrolling. And you're also going to be able to join a Facebook group where you can talk to me and other people who are working on building their own online educational platform. And then finally, we have to do our weekly giveaway for the Stock Radar membership. Every single week here on my channel, I give away a lifetime membership to Stock Radar. And this week's winner is Letitia Grant. She commented hashtag Stock Radar on my Instagram page. So you've won a lifetime membership to Stock Radar. And my membership site is going to be closing this Friday at 11:55 p.m. Eastern Standard Time. And it's not going to be back open until August 1st or later. So if you are interested in enrolling and joining Stock Radar and being a part of this community, you have up until Friday at 11:55 p.m. to join. And then you won't be able to join until August. So just in case you're interested, that is an update for you when it comes to Stock Radar. But anyways, guys, that's it for my brief channel updates here. Now let's go ahead and get into this video talking about some dividend stocks you might want to invest in. How's it going today, guys? Welcome back to the channel here. I have a special guest on the channel, Ryan from the Independent Investor channel on YouTube. He decided to stop by. So you're moving to where now? You're moving out of the city?
Moving down to Virginia. Yep, relocating. So just another move here.
Gotcha,
so,
yeah.
Yep.
So you're in the military, so you're always moving around, right?
Yep, absolutely.
Gotcha.
Always moving.
So he's stopping by just to say hello and also goodbye at the same time. But so he stopped by, and I wanted him to bring over some picks here as far as his top dividend stocks. You got some interesting picks here, and so that's what we're going to get into. But before we do that, I think it's important too that we talk about some ground rules for investing at this point in time that may or may not be applicable at other points in time, but they're very important right now. And so before we get into the picks, you want to start off with some of those ground rules?
It's always important when you're looking at these stock pick videos not to just rush out and buy stock tomorrow, all right? So we want to kind of premise, some ground rules, and that you need to be able to do your own research on these stock picks. All these stock picks that we're offering, I actually personally own them, all right? So it's kind of like a put your money where your mouth is type of perspective, so you can kind of resonate with the information and knowing that I actually own these stocks, and I don't mind pushing them out there for you guys. Now, keep in mind as well that these are not going to fit into every portfolio, all right? So again, the last thing I want to see is people rush out to buy them. If these stock picks are not going to fit into your particular portfolio, I say all the time that no portfolio has to be the same, all right? So they may fit in your portfolio, they may not, all right? When I was looking through my watch list and getting together 6 really good dividend payers that are available in the stock market. I really ran them through a lot of metrics, and these are kind of the 6 best that somebody who's looking to get involved in the stock market, maybe a new investor out there that may be really scared by the stock market, can actually look at these stocks and say, okay, I understand what Ryan's saying. You know, I feel comfortable. I recognize each and every one of these companies, and you can feel comfortable with starting some positions in each of these in your portfolio. I also want to talk about just having fair expectations, all right? A lot of people want to go for the sexy stocks out there, right? The Facebook and the Google,
the
right?
tech stocks, the FANG.
Sure.
I know I call those the market high flyers. Those are the ones that everyone's talking about, all the analysts are talking about. And in my opinion, a lot of the opportunities lie in the undiscovered areas where people aren't necessarily looking. And so typically when I see somebody pumping up a high flyer, that's when I say, okay, I think I want to be avoiding that stock. Is that kind of the same mindset you have towards that?
It is, and I think I get hit with this question all the time, you know, should I buy Facebook instead of an Apple, okay? And my response is always, look, if you have the ability to buy both stocks, they're both fantastic, but you need to have fair expectations about entering into a high growth name like a Facebook as opposed to a value play in the name that I'm going to recommend to you guys, right? So, and I always recommend that new investors get involved in the stock market more passively, right? They need to enter into the stock market and get some time under their belt becoming an investor first, okay? And as you build that time and you start to define your risk tolerance in the stock market, you're really going to get used to being an investor. And that's the time when you want to maybe start to add a little bit of growth exposure to your portfolio. And that's really one of my rules, is to have fair expectations about dividend stocks. When you're investing in a dividend stock, don't expect it to go up right away.
Yeah, it's not going to look like a Netflix or an Amazon stock for sure.
That's right.
It's going to be more of a slower growth over time. So what would you say would be, so if somebody is just getting started with the stock market, what do you think is the first place? Is it an ETF? Do you think they should start with an ETF and then get into, or do you think they can start right off with a dividend stock?
Absolutely. So there's a lot of people that are looking to start in the stock market, and owning single stock for a lot of people is scary. I invested for 7 years before I entered into single stock exposure, okay? So the best thing that you could possibly do is look at your Vanguard products, and the VYM is the Vanguard's high yield, and it's an ETF built of nothing but dividend payers, all right? And that's going to pay you around a 3% dividend in that ETF. So if you were looking to take a passive approach, that would be how you could do it safely and guarantee that you have that diversification right up front instead of going with the single stock method.
Now that's a very interesting point that he brings up here as well, is a dividend guaranteed? A lot of people don't know this, but is a dividend guaranteed, Ryan?
Well, so a lot of these that I'm going to talk about, and a lot of these stocks have been paying dividends. I mean, one of the stocks have been paying a dividend for 125 years.
Wow.
And most of these have increased their dividends for multiple decades, right? Decade after decade. So you never ever want to use the word guarantee when you're talking about the stock market, but a dividend really is the closest thing to a guarantee that you can possibly get in the stock market. And it's a lot of reason why people invest in the stock market is to get that guaranteed quarterly or monthly payment in the way of that dividend.
So when it comes to a dividend, I mean, if you're looking at a company that has decades of history of paying that dividend, it's probably a sure bet. But again, if you find a newly formed company or one that just recently began paying a dividend, understand that it's not guaranteed. They could restructure or cut that dividend at any point in time. And so I think really what it comes down to is looking at the dividend history. And I know a mistake that a lot of people make, because I see these comments a lot of the time on my videos, is they look for these stocks that are throwing out a 10 or 15% dividend yield at any point in time, not remembering that there is no guarantee on that dividend. And you know, that can be a trap for investors, is hunting for that high dividend yield and not considering, number one, can the company afford that dividend? And number two, how likely are they to restructure or cut that dividend?
Yeah, so the number one pick on my stock list is Microsoft, okay? And Microsoft hasn't paid a dividend that long. It's paid it back since 2003, and it's increased that dividend over the last 13 years. But it only pays a 1.7% dividend yield. And you think, okay, this is a dividend video. What's this doing as one of the top picks? It's a healthy dividend, and it's been sustained. And Microsoft is really in one of those transitional periods where it's going from one of its legacy businesses in hardware and software, and it's transforming to one of the very best cloud computing businesses. And it's being reflected right now in the multiple. Microsoft trades at a 30% multiple right now, which is actually above historic norms. And Microsoft has just been on a tear. And I hesitate sometimes to recommend a stock that's been on this big of an upswing, but Microsoft has even more upside potential because it's just now transitioning from that legacy valuation to its new valuation, and getting that premium valuation as more of a cloud play. So for a beginning investor, really Microsoft does it for you. And a 5-share position could run you $500. And if you're looking to start your portfolio and get some of these excellent blue chip companies in there, Microsoft is $750 billion of market cap.
Yeah, one of the largest companies in the market, and it was one that I think was on my top 5 for 2017. It did very well, and I still see a lot of potential with Microsoft, again, mostly because of the cloud computing and everything they're doing with that. And so I certainly agree with that pick as well. And what I like about that is that's kind of a blended approach there of both growth and income. So you're going to hopefully get the underlying growth with them getting into the cloud computing and different businesses, and then you get the dividend as well. And another thing we should discuss as well is the importance of a DRIP and reinvesting your dividends in order to really get the full potential that you can with these dividend stocks. Do you set up a DRIP with your dividend stocks?
Yeah, so anybody that's looking to start out in the stock market, or even somebody that's been involved for a while, we're looking to accumulate wealth, okay? And we accumulate wealth by accumulating our share base. All right, so setting up a DRIP really is very simple. It's just a setting within your account. You go in there and set it up, and those dividends that are paid to you sporadically, if you own multiple stocks, will be paid to you quarterly. And what will happen is those will automatically roll back into the stock and buy you more shares in that stock. So the next time you're paid that dividend, you're paid on that higher amount of stock ownership. It's a beautiful thing. And that's one of those benefits of seeking out a dividend is knowing that you can participate in that DRIP program and build your share base. That's really what it's about.
And the other thing about dividends is the potential to be paid in 2 different ways, of both the asset appreciation and the dividend. And also what I like about dividends is they can also be kind of a hedge against a bet. If maybe you're necessarily wrong on a particular stock and it goes down, but you're still collecting those dividends and adding to your share base, it's going to help you, start to see a positive return from that investment.
That's right.
So, okay, so I think we covered the first pick, Microsoft. We covered our ground rules here for investing. What is your number 2 dividend pick for us here?
Yeah, so the number 2 dividend, and we're probably going to take some abuse for this because Walmart has come off of its high. It's traded under the ticker symbol WMT on the New York Stock Exchange. Walmart is a behemoth, and you guys that are new investors and you want to get those cornerstones in your portfolio and you want to build out these cornerstones to be anchors in your portfolio in the case of an eventual downturn, Walmart is one of those that you want to own. It's come off of its high of 106. It's right now in the low 80s. And what I tried to do is provide you guys an attractive entry point to some of these high dividend payers. And Walmart fit the bill. From a technical perspective, I looked at the charts and they were really screaming as to establishing a nice base here as an entry. They paid out a dividend since 1974. They are traditionally just a domestic play. They only have 25% of their business international, which I felt interesting in Walmart. They've got a $250 billion market cap, trades at about 19 times forward earnings. All right. They've risen the dividend 45 years in a row. So when you allude to dividends being a guarantee, I really don't mind putting these stock picks out there for somebody that's new, looking to get involved in the stock market, wanting to get excited. And I talk all the time about resonating with the name that you're investing in.
Absolutely. Yeah, you have to really care about the business and have it be a company you understand as well. And so far, these 2 picks so far, very easy to understand, businesses we're all familiar with. And the other thing that I like about Walmart as well is as far as getting more defensive, this is a company that performs well in a bear market as well because it's the value option for people. Maybe they can't afford to go to Whole Foods for their groceries, but they can afford to go to Walmart. And so it's a company that typically sees more spending as well, or at least consistent spending, whether or not we are in a good economy or a bad economy. So it's a good defensive pick as well.
Yeah, and while we enter into that downturn, you're going to enjoy that dividend of, 2.5, about 2.4% on that, so you can kind of rest easy. And that's another thing that it's worth mentioning now with the current state of the stock market being at record highs.
Sure.
I mean, we're almost in the euphoric stage of our stock market phase now.
Yep.
Now, I don't tend to forecast stock markets, nor do I believe that's possible, okay? But it's fair to recognize that the stock market is really at an all-time high.
Absolutely.
So investing into strength is usually not something that a value investor does. But certainly we're looking at taking small starting positions in each of these dividend payers if you're looking to get exposure in the stock market as a new investor.
And then the other thing to say off of that as well, and it's probably just in case you guys aren't getting the gist, this is going to be a longer video here with not so much structured, but one thing that you have to remember too is you don't want to be lump sum investing typically at any point, ever really, honestly, unless you're in a bear market and you really want to get in at that point in time, but you want to be investing over a long period of time. So even if you had $10,000, I wouldn't necessarily say put $10,000 into the stock market right now. You'd want to chunk that up over, many months, just that way you can smooth that out and buy shares over time. Again, because we're at record highs here. So looking at stocks like this, we're talking about, entering a small initial position here and then building up your ownership stake over time.
And when I revert back to having fair expectations into buying a name like a Microsoft or a Walmart, we're looking to own these for years, okay? We're not looking to enter into these positions and own them for months and then, we're disappointed because it's taken a down click of five bits, right?
Right.
So we're looking to, take advantage of those downturns when you do get that and look at those as buying opportunities. I actually call that strategic buying. A lot of people talk about the importance of dollar cost averaging, right? And adding strategically to the stock market. But certainly if you just pay attention and monitor the stock market, you can really see, and if you've paid attention to the stock market this year, the volatility has picked up.
And so, with the volatility comes the opportunities to get in on stocks. I mean, I got in on Facebook this year. We were talking about Facebook. There have been some tremendous buying opportunities that only come out during times of market volatility. So nothing to be afraid of. Okay, so we covered Microsoft, we covered Walmart. What is the number 3 dividend pick we have?
So the number 3 one we've got has really kind of taken some abuse in the market. It's part of the staples sector. What I tried to do when I covered this sector exposure for the group here is try to hit on some of the sectors that I feel like a new investor has to have exposure to, okay? So you'll notice that I don't have exposure from utilities, telecom, materials.
Those are typically, industries that pay a very high dividend. So it was interesting to me as well, but the reason for it really made sense.
It really does. I mean, we've got Procter & Gamble that went through a huge proxy fight with Nelson Peltz getting added to the board there. And I think there's been some slowing in some of the categories in Procter & Gamble, but Procter & Gamble is one of the largest diversified consumer staples in the world, okay? And if I was going to recommend the stock at $96, I'm absolutely willing to recommend the stock here that's established a nice technical base right in the low 70s. So if you're looking to get a nice starting position and a nice 4% dividend paying stock, this is your entry point, okay? We don't want to wait till these stocks go up to 100 and then reflect on that buy point. You kind of want to buy on weakness a little bit.
And typically, especially if you're a beginner watching this, what you're going to find is that doing the right thing in the stock market typically feels wrong at the time to be buying a stock that's battered and buying a stock that's low, but you don't want to be buying stocks at all-time highs. You want to take advantage of the sales. And would you find that's the case as well? I find a lot of people say it feels wrong to invest in the right way.
You have to be somewhat mechanical and a lot less emotional about stock market investing. And that's really why I talk a lot about, if you don't have a lot of experience in the stock market, the only way to gain that experience is to become an investor in the stock market.
True.
And every day that you log and every week and every month and every year that you log as an investor, it's going to really help you identify what your risk tolerance to the stock market is. And it may be a little different than what you self-assign from day one.
I agree with that completely.
Right? Right. So,
usually we overestimate our risk tolerance until you're actually faced with the real world situation there. So very, very true.
I think this is one of those stocks that I referred to that was paying a dividend out for 125 of the previous years, right?
Yep.
So the last 62 years, it's increased its dividend over time We're looking at a market cap of 200 billion, and I think a lot of the recent pullback in the stock has actually been due to currency exchange, because 64% of their business is actually conducted overseas.
Oh,
so
really?
This is a business that does business in 180 different countries.
Okay.
That's how big Procter & Gamble is. And it's also one of those stocks that I recommend that you can buy and actually hold forever, okay? It makes a very rare list for me of cornerstones in a portfolio that you can buy and invest and set up on a dividend reinvestment.
And then just forget about it.
It's like a money machine. It'll pay you the rest of your life. And I've owned Procter & Gamble now for over 5 years, and I've never regretted one day being a part of this fabulous company. It's really one of the best brand recognized. You've got Pampers, Tide, Downy, Gillette, Pantene, just to name a few. So from a worldwide perspective, these products are being identified, and people can really relate with that product.
Yeah, and like you said, they're the staples. They're things you're using every single day. And again, just talking more about defensive picks, this is another defensive pick here, because people are still going to buy their laundry detergent and their toothpaste no matter what the underlying economy is doing. And so that's, again, a lot of these picks go undernoticed in a good economy because they're not the high flyers, because you're not going to suddenly see crazy growth in the toothpaste market, you know, but you're going to see consistent spending and steady growth over a long period of time. And so again, that's the characteristics of a good dividend stock. And oftentimes these are boring investments, and that's kind of what makes a good dividend investment. Is if it's boring, then that's probably a good thing when it comes to dividends.
Just to tie it back in, you know, a lot of new investors, when they get involved with the stock market, they really have unfair expectations about how a dividend payer is going to behave once it's invested in. So I really think that that's fair, that if you're going to invest in a good dividend payer and you observe the stock a month out, you may be potentially disappointed. The thing about it is that investment capital that you've got in a good company like Procter & Gamble is going to behave in a way that a value investment will behave in the stock market. It's not going to be static cash like you have in a savings account. So people are often surprised when they invest in a stock and invested capital behaves in a manner that you've asked it to behave in.
Yes, that's true.
And that's part of the conditioning that we talk about as well. You know, a lot of people need to get involved in the stock market as early as they can to really start that mental conditioning of really buying into a good plan, whether it be cornerstones or dividend investments within the portfolio or passive ETFs within the portfolio. There's a lot more inherent benefit in that, in getting that experience becoming an investor in the stock market.
All right, so we covered our first three. Now let's move on to number 4, the fourth dividend pick we have here for you.
Yeah, so this has been a long-term holder of mine, and I actually substituted one of my other very important industrials plays in 3M, and I substituted this fine company, traded under the ticker symbol UTX. It's United Technologies. It's traded on the New York Stock Exchange. This has been a stock that I have owned for years, and I have been proud to do so. It pays a nice, healthy dividend of 2.2%. United Technologies is involved in aircraft engines, elevators, and air conditioning, all right? So when Ryan talks about some of the boring aspects of owning some of these stocks, all right, for me, there's not a lot boring about making money. And for the bottom line, for the viewers out there that are watching the message and trying to extract some value for themselves, right? Sometimes some of these boring stocks are the very best investments.
Oh, absolutely. I couldn't agree more. You know, look at, again, telecom and the utility industry as well, also good areas for dividends. That doesn't get much more boring than power lines and telephone lines. That's you know, and then just having the subscription revenue type thing with the telephone companies, with your wireless carrier, and then, you know, paying your electric bill every single month. That's pretty much the business for these guys, and very boring but very good areas for dividends.
And what we tried to do for you guys is really identify those premier sectors for you guys. If you were a new investor and you were, you know, looking at the entire investing landscape, it can be really, really intimidating. You know, where do you start? And really where it starts and ends with me is identifying the sectors that I want to be involved with, okay? And it starts with technology. That's why we had to offer a pick from technology, staples and discretionary, certainly. The financial sectors, the industrial sector, and the healthcare sector are places that really you need to be You know, and if it's going to be at the expense of the utility sector and the material sector and even the energy sector, which I'm very bullish on right now, then so be it. I'm acceptive of that, because new investors, you can't own the entire landscape at the beginning.
True.
If you're
Yeah,
looking
you got to pick and choose. And I understand where you're coming from, because you just don't see much growth of the utility stocks and these telecom stocks. And when you look at something like AT&T over the last 5 years in this roaring bull market, they've done nothing.
Yeah.
And so, yeah, that higher dividend yield is more attractive, but you want to have two things with your dividend picks. You know, you want to have asset appreciation and that dividend. And if you're looking for just one of those things, then maybe you would look at something like AT&T, but I don't see the growth potential for a company like that.
That's
looking
right.
at, you know, the history there. So you want to have both components. Even if a stock pays a lower dividend, but you have growth potential there, I'm going to lean more towards that than just a pure dividend play or a pure income play.
That's right. And again, to re-emphasize, what we're looking for here is a healthy dividend. And there's a big difference, just because it's a large dividend and you're going after an ExxonMobil and a Chevron, right, which pays those higher than average dividends.
Yep.
Guys, investing in energy is very, very tricky. It's a tricky sector to invest in. And it's not something that I would advocate that a new investor go out there and just jump into, the oil sector right away. Allow yourself to define that risk tolerance that we're talking about, and then go ahead and dabble in some of those other sectors, major sectors. But certainly there's the premier sectors that you want to be looking at to
definitely.
start. UTX is about $100 billion, and they just announced the acquisition with Rockwell Collins, which I think is going to be a real growth driver for UTX, and it really hasn't participated. When I looked at the industrial sector as a whole, when I was looking to get my #1 pick for you guys, I was looking at companies that I absolutely love: Boeing, Lockheed Martin, Caterpillar, Cummins, John Deere, and they've all just run to the moon. Boeing's back on its streak again.
Yep, absolutely.
So I was really trying to find a good play that I felt comfortable with a PE that wasn't totally out of control.
Yeah.
So with a PE of just over 17 forward earnings, I think we're really good. We're in the driver's seat to grab just a little bit of industrial sector exposure through United Technologies.
So what's the next pick here we have, number 5?
Yeah, so this is really important. This part of a sector that's just been absolutely beaten down over the last decade, and it is the financial sector. And it's one of those sectors that you have to have exposure to, okay? We don't add a lot of exposure to it because of the growth perspective. We want to invest in this particular name because a friend of ours, Warren Buffett, invests in Wells Fargo, traded under the ticker symbol WFC on the New York Stock Exchange. I own 4 major banks. Wells Fargo is one that I've owned for many years. I own Bank of America, JP Morgan Chase, and Citigroup. I own all 4. Wells Fargo is one of my favorites, and it has taken a beating, and rightfully so. It really has. It's gone through the account scandal, and there was a management problem from the top down. And I believe Wells Fargo really is taking a lot of initiative to trying to clean up the program there. And like what Ryan's saying, you don't necessarily want to invest into strength. The underlying assets with Wells Fargo is that they've got close to $2 trillion in assets. All right, we're looking at a 2.9% dividend clip. Now, I'm not saying that they get past this tomorrow, okay?
Yep.
But we're looking at 12 times forward earnings. And for a company like Wells, we're sitting on a $250 billion market cap. It really just doesn't get any better when we're looking at loan growth potential, fee income, and rising interest rate environment. And that's why I really stress for new investors to make sure that they're looking to get at least a little bit of financial exposure in a well-diversified stock portfolio. And Wells Fargo really, really meets the bill. Yeah, so the final pick really is my absolute favorite. And really, if you guys were looking for a stock pick, whether or not you were looking for a dividend investment or just a fantastic investment, Johnson & Johnson is also one of my companies that I recommend that you could just buy, hold, and forget about for the long term.
Yep.
It is that good of a company. Now, there's a lot of different facets to owning Johnson & Johnson. From a technical perspective, the chart certainly caught my attention. At setting this base right here in the low 120s, you're probably getting a very good entry point on J&J. Half of its business is here domestically, half of it is international. So you're getting some international exposure, $333 billion in market cap, and at 15 times earning, right? We're right at that sweet spot of looking at about a 16 multiple, right? For a good entry point and a good dividend payer. It's paid the dividend since 1944, guys. So it really doesn't get any better. 56 years straight, it has increased the dividend for shareholders. It has done nothing but reward shareholders for owning this fine company. It's really broken up into 3 different segments. You've got the pharmaceutical side, you've got the medical devices side, and you've got the consumer product side, which a lot of you guys will recognize, okay? Band-Aid, Tylenol, Johnson's Baby, some of those products that people have to have. They're not optional.
They're your staples,
That's,
you know?
exactly.
There's a lot of people that take Tylenol and these products every single day. And so, you know, that's what you have to think about with these companies, is these are products we're using every single day religiously and, you know, habitually. So that's what I like to see from a dividend perspective.
And a lot of people, when they're trying to enter the stock market, they try to overthink it. And a lot of these good quality companies are right in front of your face.
And you overlook them just because they're not in the headlines. They're not making headlines right now because
they're not.
You know, they're flying under the radar. All you really hear about are the high flyers, but there's all kinds of great opportunities that are, you know, not necessarily being talked about or making the headlines here. So you just have to do a little digging.
That's so true. It's really hard to generate intriguing, you know, news.
About a company like Johnson & Johnson.
Right, because you know, everybody wants to talk about Netflix and Nvidia, right?
Amazon,
that's right.
All these guys, you know, they're doing amazing things. You know, you're not seeing Johnson & Johnson getting into artificial intelligence, but they're doing what they've been doing for, you know, over 100 years very well, or close to 100 years. They're just very consistent, you know.
They've made some very, very good strides with regard to their cancer and stroke prevention. And then the last aspect that I will mention, and this is something that I really take seriously when recommending stock picks for new investors, is that Johnson & Johnson is one of the very rare companies that has a AAA Moody's rating for their financial stewardship. And that is extremely good to know. If you're going to be a stockholder in a company, it is so nice to know that they are taking and being good stewards with their money and turning back that money to stockholders. I've owned Johnson & Johnson for years, and I certainly don't mind making that recommendation for any new investor out there that's looking to get a cornerstone in their portfolio. Johnson & Johnson is another one of those stocks that I recommend that you buy, guys, and you keep it forever. Become an investor, and you will own Johnson & Johnson, and you will enjoy owning Johnson & Johnson really over the long term, and really start to understand, you know, why you're a dividend investor. And it really takes time to validate that for a new investor. You got to get that time logged in the book to really understand why you pick quality names like this in the stock market.
Absolutely. All right, guys, well, that's going to wrap up this video. Ryan took a 4-hour trip to drive here, so let's show him some appreciation. It's the Independent Investor on YouTube. I have it linked up down in the description. So the one thing I want to mention too, you're doing a lot of live streams now, right? I don't see a lot of that going on. You do it weekly or as close to weekly as possible?
Yes, I do it every week. I've been going on Friday. I may switch it to Saturday night, but look at those live feeds anywhere in the evening, 9 o'clock Eastern Standard Time.
Right.
It really gives a great opportunity to provide some visibility to what we're doing on the channel, and it gives kind of a weekly update for people to throw, you know, questions from wherever that may be, you know, as simple as it may be, as advanced, to kind of throw those my way and get a different perspective.
Very cool. All right, guys. Well, thank you so much for watching, and I will see you in the next video. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.